Hello, everyone. And today we're going to be going through and unpacking the RBA's decision to hold the cash rate for the second consecutive month. And once again, I'm joined by Mason and Nicola. How are you?
Very well. Thank you. Very well.
That's it.
Yeah,
That's
good.
it. And
I'm
hello. Sorry, Nicola. And good to hear. And hello to everyone as well, too, who's jumping in live. Now, I know this was a highly anticipated cash rate decision because it could have gone either way. And I must admit that a lot of people are feeling like they're at kind of, the edge of a cliff in some people's scenarios where it comes to households. And I think, most people will see today's decision as a bit of a sign of relief. Is that the kind of sense that you got as well too, Mason and Nick?
Yeah, definitely. I was having a conversation with a client this morning, and she was hoping for a hold. So she'll be very happy indeed.
Yeah, definitely. And I guess that's the sense for you as well too, Nick.
Yeah, for sure. I think it's a relief for a lot of people. But yeah, just I don't know how long it'll be a hold for is my take on it. So
yeah, well, it's gonna be interesting the way that they pan this out, and we'll go through some of the points and we'll unpack this a little bit because there was some interesting comments out of what the RBA governor said. And I think this is his last one, or this might be his second last one, because I think the next governor kind of comes in, I think it's in September. So anyway, we won't be hearing from Phil Lowe for too much longer. It'll be a new person. But anyway, let's get into what his comments were, because I think it's really good to unpack this, because it talks about what's obviously happening in the economy now and the effects, and what's happening likely in the immediate future. Okay. So obviously, general advice warning, the information we go through is of a general nature, and please do not act on these if you need financial advice. We're your financial advisors, so speak to us personally about your situation. So RBA leaves the interest rates on hold for the second consecutive month, okay? And what we want to do is just go a little bit back to see what's actually happened. And you literally need to be living under a rock to haven't understood what's been happening, because it's been the biggest effect on people's cash flow, especially because what you've seen here is this kind of 4% increase over the last year or so, okay? Coming off historical lows that were on hold for a very long time. We also see that there was this kind of decrease period, up period, and then there's been this kind of decrease period since about 2012. So this rapid increase that we've seen has been short, sharp, and hopefully very effective, okay? And when we mean by very effective, it is to combat inflation, which has been very high, continues to be high, but hopefully we start to see a sense of this moving in the right direction, which is to more reasonable levels. It's very interesting when you see this graph, isn't it, Nick and Mason? Like, I know we've seen it many, many times, but to see the rapidness and the short, sharp approach that the RBA has taken is astonishing.
yeah, particularly when it's been down from the whole time since 2012. So the last 10 years, it's just such a, not shock to the system, but it's just something I haven't been used to for such a long time.
Yeah. And it wasn't a conversation that was had around the normal, kitchen table maybe 3 years ago, 4 years ago. But now, everyone's talking about cost of living, and the effects that's happening across the board. All right. So just so everyone, RBA governor comes out, he gives a statement, kind of posts it online for everyone to see. But I wasn't going to go through the whole statement today. I just wanted to go through some key points and just discuss these today. So point number one is around inflation in Australia is declining, but is still too high at 6%. And I know that everyone in our firm agrees that 6% is too high. It was probably Nicola's comment before to say that she doesn't know if these rate cycle increases or the rate hiking cycle is over, because inflation is still at 6%. It's not within the target range. It needs to be at a significantly lower level. So the other thing was that the central forecast for CPI inflation to continue to decline, to be around 3.25% by the end of 2024 and be back to 2.3 target range by late 2025. Don't like predicting too much, but I wouldn't be surprised that this happens quicker than they're actually saying. Okay, we've seen it across other countries around the world. We've seen New Zealand go into a recession. We've seen other countries go into a recession. We see a sharp decline in inflation in the US. Okay, I would not be surprised if this actually happens much quicker. And also to consider, they're saying that this is happening at a pretty rapid rate. If inflation's at 6% and it's down to 3.25, by the end of 2024. I would not be surprised if inflation is at these levels by early to mid 2024. Now, like I said, I don't like speculating, but when you speak to accountants, you speak to bookkeepers who are managing business affairs, a lot of businesses are hurting. A lot of their costs are really affecting the way that they can do business. And they're really looking at how they can cost cut, how they can stop spending. And these contractions is what's going to slow down inflation. And I think that this is going to happen quite rapidly. What's your view on this, Mason? I know that this is what the governor said, but what's your thoughts on this? Do you think that we're tracking on this mark, or are you getting a sense of something else?
Yeah, no, I tend to agree with you. I'm not sure how quick it will happen. As you say, we don't like to forecast too much, but based on what we're seeing around the world, I agree. I think CPI hopefully can get to this range earlier than they're sort of suggesting here. But I think it's a clever use of language here by the RBA, because I know in previous statements they were saying that the forecast was around mid 2025. So they pushed that out a little bit by saying late 2025. So they're sort of dampening that expectation, giving a bit more breathing room, these types of things. But hopefully it is earlier than that. But I thought that was not strange, but a tactful way to use a bit of language there.
Yeah, and I also think that they're also anticipating there to be a soft landing, everyone, as well too. So in this whole approach is that this inflation is going to kind of come down, go into this smooth range and kind of go back to normality. I reckon there's a low probability of that happening. RBA, like we've seen in the past, even governments before, they usually overshoot and then, things don't play out exactly the way they can. I think long-term, the country is well positioned to be still a long-term good country, good economic growth. But we've also gone through unprecedented times. COVID-19 and what happened there in regards to shutting down an economy and then pumping billions and billions of dollars into an economy. This is the same central bank that said that, rates weren't going to move from 2000 to 2024. These are the same, economists that were saying that, inflation is going to be transitory. Okay. We can only control what we can control, but just beware. There might be some turbulent times and not be as smooth sailing as the RBA has put it. Nick, any further comments on that one? You know that I love this stuff, but
not really. I think you pretty much, summed it all up. It'll be a matter of waiting and seeing.
Yeah, definitely. I think another point was around the RBA acknowledging that household consumption growth is weak, as well as dwelling investment. So, Nick, they're seeing data now that is actually telling them that the household consumption is actually not growing. And so, I know we're seeing it in our clients being more conscious of where they spend their money and how they spend their money. And on the lead up to doing that, you go out, you start to see that retail sales have started to go down. Activity is starting to slow down in some pockets, not in everywhere. There's some areas that are still flourishing, but we're starting to see that weakness as well too, aren't we?
Yeah, for sure. And this is what the RBA wants, because both of those indicators are indicators of demand in the economy, and they want demand to reduce so that the economy starts to slow a little. And like you said, people don't have as much discretionary cash flow to spend. So it's what they want to see, as painful as it can be.
Yeah, definitely. It means that the economic levers that the RBA is using is actually working. Okay, because if it wasn't and we weren't seeing these signs, we'd be much more concerned. Okay, much more concerned. So conditions in the labor market remain tight, although they have eased a little. Now, this is for when you talk about a soft landing or a hard landing, or when you talk about, John, what the hell are you even talking about when you talk about landings? Okay, we're just saying after this rate cycle, what's the economy going to look like after this cycle can be completed, okay, or done. Now, for me, conditions in the labor market and the next point around unemployment is something that needs to be very, very closely looked at, because when you think about a business and a business Businesses employ people, both big and large. The Australian economy is built on small business, okay? Small businesses' biggest cost or expense is wages. And soon as they start to feel the heat, they start to go and look at all of their wages, and they start to look at the biggest one, which is, all their costs, and look at wages, which is their biggest cost. And they say, how can we reduce this? And now we're starting to see layoffs. And we've been talking about this. The tech companies, especially in the US, done it very, very early on. They made some mass unemployment, but we're now starting to see it starting to happen in Australia. And so unemployment from the RBA is expected to gradually rise from 3.5 to around 4.5% later next year. Now, that's a 1% increase, okay? If you actually know the numbers around that, it's a pretty huge amount of numbers of people that are going to be unemployed or expected to be unemployed. But Mason, I also think that the RBA doesn't want to scare the Australian economy in regards to the rough, turbulent time that this could actually spike higher than this before returning to a much more reasonable level, don't you think?
Yeah, exactly right. So it's hard for the RBA to get this perfect. And it's easy to read, and you mentioned just there around the numbers of people. What is 1%? What does it actually mean? Like that's a lot of people. There are not there's people behind these numbers, unfortunately. And that means rent's not being paid, mortgages not being paid, these types of things, which put massive
businesses
pressure.
Not getting paid on their invoices. It just has this massive flow-on effect.
It's a massive flow-on effect. And they could overshoot this, and it could be 5% or 5.5%. Who actually knows? But yeah, it's probably the saddest point of the whole rising interest rate cycle that's happening at the moment is this unemployment that will happen. Well, will likely happen in the near future. And
coupled with that, usually unemployment is at when rate cycles are high. So you've got people in a scenario where rates have increased because of monetary tightening. They've tightened too much. They've lost their job, and they're in a scenario where there's foreclosures on houses. Now, this is the money game, and this is going to sound, sad, but it's true. Be greedy when people are fearful, and be fearful when people are greedy. We're now starting to see, we talked about it yesterday on Lunchtime Money Live. We talked about people reselling properties within 12 to 2 years. That's one signal. The unemployment is the other signal, on if it is a good opportunity to start looking at things to, potentially pick up that might be at a discounted value. Now, people might be there going, John, you talk about not buying, not trying to time the market. No, you're not trying to time the market, but you're also trying to be making sure that you make wise business decisions or investment decisions on your money as well too. And if something's cheap, you're going to look at it, aren't you? Okay, if it's of good value. So, which is interesting because the stock market seems to be just going at record highs at the moment and seems to be doing very, very well. It just goes to show you how much cash has been sitting on the sidelines of investors, ready to kind of rebuy over time. So there's been a lot of institutional money, a lot of professional and sophisticated investors holding cash on the sidelines, waiting for some of these turbulent times to happen. And when people are selling, there's more people buying. And unfortunately, the consequence of inflation is that the rich are getting richer and the poor are getting poorer. And there's this massive wealth divide that's happening. And unfortunately, there's more money in the hands of the rich than there is in the poor. So we'll start seeing that happen and continue to happen as unemployment happens. That wealth divide is what I'm talking about. So consumption growth has slowed substantially due to the combination of cost of living pressures and higher interest rates. It's good to see that they're acknowledging this, okay, that they're not saying that everyone's honky-dory and there's, I think the RBA governor pretty much said it's other people's faults, no, this is everyone hurting. But I think a lot of this statement, to boil it down, is a lot of noise, everyone. This is all based on inflation. The RBA is moving based on inflation numbers. When you talk about unemployment, you talk about everything else, they are looking directly in regards to that inflation number. So when inflation numbers get released, you want to be making sure that inflation is tracking down. And the quicker it tracks down, the quicker the RBA can make decisions on either holding, releasing, no longer in a rate cycle. And Mason, Nicola, I don't know if you feel that way, but for me, that's what I feel. It's really based on this inflationary number. The rest of it is just noise. This statement that the RBA gave out was a a lengthy statement, but for us to summarize it in 5 or 6 points, really, it's just about inflation, and subdued to that is around then the consumption of goods and the unemployment as well.
Yeah, I tend to agree. I think it's, as you say, inflation's the headline, and there's lots of things that sort of come under that headline of inflation, which is unemployment, consumption, growth, these types of things. So, at the end of the day, RBA's job is to get the inflation rate to that 2 to 3% range. So that's what it is.
Definitely. Now, another one, Nick, that I might get you to comment on, which was actually quite interesting, because we talked about a little bit about it before, but the RBA in their statement, or the government in the statement, actually wrote this. He goes, some are benefiting from rising housing prices, substantial saving buffers, and higher interest rates. This is a very interesting point for people that couldn't predict, but were well prepared for economic downturns.
Yeah, 100%. And like we have chatted about this before, monetary policy doesn't impact everyone in the same way. So households that perhaps don't have debt, have substantial savings buffers, they're getting higher interest rates on their savings or term deposits, or, those fixed income kind of accounts, as well as if they own property prices rise, then they're getting that benefit without also having the increased mortgage repayments. So there is a portion of the population who probably aren't doing too badly with these changes.
Yeah, definitely. And it's good learning for people. You might be sitting there going, oh, it's not benefiting me at the moment. Well, what can I do to put myself in a position that when this happens at one point in time, another time, that I can be the person that's benefiting from this? Now, I've been very fortunate to work with a lot of clients over many years, and that are benefiting from this situation, that have put themselves, they've worked, 3, 5, 10 years with me, and are now in a scenario where they are benefiting from this scenario. And it's not going to happen overnight if you're sitting in their scenario, like in the scenario right now, going, oh, this is really hurting. You'll get through this. This is probably your first one. Like we said, interest rates haven't risen in the last, say, 10 years, okay? But they will rise again at one point in time. Okay, and how can you prepare for that? How can you build up your safety bucket? How can you create the right mindset and the right behaviors? These things take time. Yeah, and it's not about getting rich quickly. It's about doing things over time, doing them right, training yourself and getting to where you need to get to. And that's what we're here to support you to do. And it was very interesting that the RBA has actually put that in that statement. So that's a wrap from us, and I'm sure people will have some questions once they watch this as well too. So please, if you're in the Facebook group, leave them in the comments. If it's on the email, please just reply to the email. If you've got any questions, then we'd be more than happy to answer those questions. But a second consecutive hold from the RBA. We'll see what's going to happen moving forward. But from what the RBA is saying, there might be more rate hikes, but they've opened up the opportunity to say that there might not be, depending on that inflation number. So the inflation number is the biggest number to be looking for at the moment, and we'll be keeping our eye closely on that one, plus all the other factors that are affecting your investments and your finances as well. So have a great evening and speak to everyone soon. Thanks for jumping on, Nick and Mason, and thanks for jumping on everyone else. Have a good one.
See you guys.
Thanks, guys.
See ya.
Bye.
Bye.